Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today we've got Scott with Sow and Reap Capital. We're going to talk about a topic that I think is very relevant to what's going on right now. We've got selling pressure in the market, absolutely tanking everything. That was Friday, 9/23. That's when we're taping this. And a lot of people, their viewpoint changes on the sector based off of the price action. And what they do is they basically form a narrative around their opinions on a sector, opinions on commodities or whatever it is, solely based off of the actions in the market. What I've showed in the past here is that during bull markets, we can still see 50, 60, 70% declines in these stocks, in a lot of these commodities. The question you're going to ask, I think yourself is, are you a investor? Are you a short-term trader? And, what is your own thesis, or what is your own strategies to maximize either gains, maximize saneness, lower stress levels, however you want to do it? You have to figure that out. And just because the market goes down doesn't necessarily mean that the sector is not in a bull market. Doesn't mean that the sector's bad, that it's not going to perform in the future. Timing the short term, like I've always said, is the most difficult thing to do because anything impacts it. And when you have market conditions in the short term where people are panicking, where emotions get into either buying or selling, that's usually when opportunity starts to arise. When people get very panicky to the downside, that's a good time to buy. When people get FOMO on the upside, that's usually time to sell. So, Scott, I got a question for you. I just wanted to kind of say all that in the beginning.
Yes.
I guess the question is, with the recent price movements that we've seen in the markets, does that impact anything in uranium, in commodities, or anything that you're viewing? And why does it not impact your viewpoint?
Well, short-term movements don't really matter to me. So I always zoom out. I look at the bigger picture. I look at the entire money flow and what's happening. So, the first thing, the most important chart for me is the monthly chart. So daily charts, I can rule that out completely. I don't even have to look at it, to be honest. And monthly chart is all that matters, looking at the ratios and things like that. So it doesn't matter. So, and I think it's really, for me, it's all about understanding and doing your own research to try and understand what can happen. So for me, nothing in the market surprises me because I know there are infinite possibilities of what's going to happen, what could happen next day or next week or next month, right? And if it's very simple to see if you just study the markets. And let me just take you back to the commodities boom of the 2000s, because here, I mean, it's unquestionable that we've started the commodities boom in 1999 for oil, for example. But then we had a period like this. It was clearly a boom, but we had a pretty big drawdown here. And what is that measured move? So price range, if I just do a quick move, 52% decline in oil price in a secular bull market. And if you keep that in mind, and if you know what's happened in history and what is likely to happen during a commodities boom, because commodities is a massively volatile sector. So these type of moves are completely normal in a secular bull market. And so if I just overlay this, and not saying this is going to happen, but this is what you need to be prepared for when you're investing commodities. If I just overlay this entire chart, right? So from here, from this run here to there, and then just match up the fractals of the chart, you can see that with oil, for example, coming down to like the $50 mark. I'm not saying it won't. I think we have a massive support around the $75 zone here. But even if it did, here's down below the 200 weekly moving average and came all the way down below. That's nothing out of ordinary, right? It will just be a repeat of the 2000s run. And what does that mean? It means, for me, it's just a great buying opportunity. So for me, it's always zooming out. knowing all the possibilities, and if I just take you back to, so okay, let's just look at uranium, for example, right? Because that's what most people are interested in. So with uranium right now, we are sitting, this is the 200 weekly moving average. This is chart of URA on a weekly time frame. And this is the 200 weekly moving average. What we're doing is probably just hanging around this 200 weekly moving average right now. And it could pierce slightly below it. That happens a lot. But why does it not concern me at all? Because, okay, so you've seen the first proper bounce here. We're coming to test it for the second time. But if you go to any chart out there, right, it could be general equities, it could be anything, right? So let's just have a look at the Apple chart, right? And I'll show you what I mean.
I do want to give one distinction so everybody kind of gets caught up. What Scott said earlier was a secular bull market. What that means is a long-term bull market that lasts over a decade or more. Cyclical movements with a C. S is secular, C is cyclical. Cyclical movements are movements that occur up and down cycles within a larger cycle. So what everyone's worrying about is they're worrying about the cyclical movements in a secular move. The cyclicals, the up and down movements that happen, and you can see it in Apple there, the up and down movements in a very large uptrending fashion. So when people say, what gets difficult is these shorter term cycles are harder to predict, and these cycles overlay over each other. So the way that I've always viewed it, and this is just my opinion here, is I invest for the big move because that's where the big money's made, and I live with the volatility. And my strategy is to buy low, get in, ride it, and as long as the fundamentals, the ratios, the valuations, all that stuff is good, and the market conditions continue to drive money into it, there's no reason for me to sell. To time all the short-term movements, you can make grave mistakes in that short-term timing because it's not as reliable. And those grave mistakes can either be in missed opportunities or in losses, just outright losses. The younger you are as a trader, I think the more mistakes you're going to make, especially on the short term. So the way that you avoid those mistakes is you don't trade in the short term. It's that's the way that I view it. So, you know, I've tried trading in and out before. It's really difficult because overall markets, news, all these things impact the commodities market. And I know a lot of people think that that decoupling means that the markets will be completely separate, but there's always some sort of magnet of the market together when things get to the extremes. When the extremes are to the downside, things get leveraged. People get deleveraging. There's panic in the markets, and they basically just sell everything. That doesn't mean that we are coupled back with the market necessarily, but it also doesn't mean that we're fully independent of the market. These markets aren't super straightforward, and they're not simple. They're highly complex. You know, you kind of have to look beyond the market and look at the people interacting. And I do want to make one statement. When you start to panic and you get these, like, you know, I told you so people and all this stuff, like in the short term, it goes down a little bit and they're like, oh, see, it's going down. Guys, you got to get those people out of your life. Like they don't mean anything. Like you have to look at the bigger picture. The up and down movements will always be there. And just because it went down doesn't mean that whatever reason they assigned for this move down is the actual reason. Right now, there's a lot of panic in the markets, but we're seeing fundamentally that things are actually getting worse, not better. So worse as in worse for end consumers, better for investors if you're investing in that commodity. The deficits are getting larger in uranium. The deficits are getting larger in oil. It is complete garbage that whoever states that we are killing demand is a false statement. Go look at inventory. Is inventories going down or up? They're going down. Okay, that's a false statement. So I hear a lot of people say they're going to kill this, they're going to kill that, they're going to do this. They haven't killed anything yet. And I find it very hard to believe that oil demand on a global scale will be killed by raising some interest rates and you've got an entire continent short of energy massively. So I would be very careful to when people start throwing all these things around, because they're looking at the old paradigm, not the new paradigm, where people are literally going to be freezing. It's the potential's there. And this is with no risk. There's no risk in this price, especially oil. There's zero risk here. To me, the price is very low. If someone said Russia was at war with Ukraine, they've got sanctions all over the world. Germany may or may not have oil or natural gas to heat their country. Europe is going to be under pressure, all of Europe, during an entire winter. What would your guess that oil would be? And I'd be like, it's not 75. I wouldn't guess that. But I know there's a lot of fear in the market, and the inventories continue to deplete. Inventories rule all. Paper markets. When there's fear in the paper markets, that's where the opportunities present themselves. And when you buy a March 2020 bottom, you know what you're going to be buying? You're going to be buying in the conditions that feel like this. That's what it feels like. So if someone is watching something going down and they're panicking, that's usually the time that I get aggressive. Unfortunately, I know I panic buy. So that's what I mean by, so when you guys are feeling this panic, right? I do the opposite. Like I panic buy when everyone else is panic selling. That's what I mean by panic buy, because I still feel those emotions. I still feel like, hey, oh, my account's down. Okay. But I know like this is the time to do it. It's just based off experience, I guess. And just because you have experience doesn't make it any easier. You're still going to be a little bit, out of your element. It's not like you're just strolling down the sidewalk in a sunny day that's 75 degrees and some shorts being like, man, this is pretty comfortable. You might be getting some butt puckering moments where you're like, man, this is getting down there. It's looking pretty bad. And it's like, well, screw it. I'm going in. Right when you see that reversal kind of pop back higher. If you're trying to catch bottoms, that's what it's going to feel like. And a lot of people, they're not able to do it. They're not able to make terms with the way that they feel. They can't be the Han Solo guy buying when everyone else is selling. And that's where all the money's made, is on the entry point. So what do you think, Scott? What's your opinions on all this? Are we getting to a bottom, or do you think you don't know, or what's your opinion here? Here's probably the number
I don't know
one.
where the bottom is, right? I mean, I don't think anyone realistically knows where the bottom is, but all I can say is I think we're in an accumulation zone. And what I mean by that, I'll just go back to the Apple chart, and I'll just make a comparison here, because I think this you see absolutely everywhere on almost every single major chart. So this is a 200 weekly moving average, and the reason why I like 200 weekly moving average so much is because it works on so many different charts, and it's like, as you can see, like it's a perfect bounce zone. It has been for Apple, for example, right? And it has been for a lot of charts out there. So if you look at Apple, and let me just take you back to the Euro chart, because URA, let's have a look at it again. So we've tested the first time, we're coming back down to it. And that's important, because what happens is usually it bounces multiple times off the 200 weekly moving average before making a major move up. So here you see 2 bounces here of the 200 weekly moving average. You see 3 bounces here. So that Euro move could potentially be something like that. You appear slightly below, and then you consolidate a little bit further and then make the major move next up. And so you see something like, so here what I'm trying to say is, I think you've just got to zoom out, forget about the daily movements, forget, remove the emotions, because I think you're just going to be wasting yourself if you focus on the smaller time frames. You just have to zoom out and look at what happens. I mean, if you look at the monthly chart of Apple, okay, this is how ridiculous this might look in a couple of years' time, right? Because right now, people are literally panicking about a move that might look like this, right? That's the panic, right, Andy?
Yes.
On the weekly time frame. Okay, let's zoom out and see where that was. Okay, where was it?
That's the whole point.
Find that dot.
The whole point is, when you take a bigger picture view, you can't even see it really.
Yeah, it's right here. It's right here, the little thing. It doesn't matter. Like, I mean, this is where I think you just need to absolutely zoom out. Look at the money flow. Nothing's changed, right? DCJ divided by DJI. This is my favorite chart, as you know. Like, what has changed in this picture? Like, what has changed? You see a rounding bottom. There's no disruption to this uptrend here. And money's flowing in. It's very clear that money's flowing in from the general equities into the uranium sector. So for me, there's absolutely nothing to worry about. And I think you just, the more charts that you look at, I think people, the benefit of looking at a lot of charts for me is that I am open to all sorts of possible outcomes in the future, because I know like charts are just a probabilities game and it doesn't mean much. And I think one of the greatest investors of all time said it's more like a coin flip. Charting analysis. But I mean, I think it does give us a very great tool to get in and out, because obviously we can see whether something is undervalued or overvalued at the time. But I mean, you just look at a lot of charts, go back to history and study what's happened in the previous commodities bull market. I can guarantee you that you'll feel a lot more comfortable where we are right now in the commodities bull market.
I know when I read in the comment section sometimes, I see people, you know, they talk about, I don't know, certain people, I won't name names, and they're like, well, XYZ hasn't been right for like a year or two, even though they're ultra bullish. And you know, what's your thoughts on that? I mean, is this something that, can you time this in a time frame within like 6 months to a year? Or is this something that a lot of people are taking the big picture view? They're letting this stuff kind of ride all through as we ride through I'll call it a stagflation, inflationary recession. That's kind of the price to pay, the volatility to get the big returns, right? And we can't pinpoint it that minutely. What's your opinion
Well,
there?
I'll just say this. Can you time it? Well, you could get lucky and time it, right? I think you could definitely get lucky and time it right. And then sometimes when you buy, it goes straight up. Like some of the trades that I've made during this commodities bull cycle, like I got in within a couple of weeks, a couple of months, it was like 4x, right? But I would say they were luck, right? Because sometimes you just need to wait it out and just wait forever. And I'll just say this, because if a famous investor like Philip Fisher, I think it was Philip Fisher who said this, he always gives all of his picks 2 to 3 years to play out, minimum 2 to 3 years to play out, because from his experience, if it's not working for him and he gets out after 2 to 3 years, usually it goes ballistic, right? So I think the timeframes that all the famous investors give to their investments is usually 2 to 3 years before, you know, they determine whether it's working or whether it's not. So for me, I think, I mean, uranium bull market, I mean, we've been in consolidate, if you look at CCJ, if you look at the leaders like CCJ, it's been on a pretty steady like uptrend, right? So obviously CCJ has been working. If you look at other developers and things like that, they've probably been in consolidation for about a year. And that's pretty normal for a commodity to go under that type of consolidation in the early stages of the commodities bull cycle. And so for me, it is actually, some people might not like it because I'm still like way bullish. But for me, it's bullish because it tells me that we're very early in the bull cycle and we're nowhere near the top. When commodities is running this slow and it's just going sideways forever and ever, it just means we are super early in the cycle. And, you know, with uranium and things like that, I don't expect the consolidation to last over 2 to 3 years, right? So I think we're nearing the end of the consolidation. And I think it's, yeah, you can't really time it, but you can sit in it and wait for the tidal wave of money to come through. And that's exactly what I'm doing. I'm just sitting in them and just waiting for the tidal wave of money to come through because I think it's going to happen. I've got very high conviction that it will happen. And yeah, I just sit in them.
Here's a question. And I know how I feel about this, but we'll see what Scott feels about this. Okay. If you were to sell all of your uranium stocks and you were to sell out of everything and convert it all to what? Well, what else would you hold?
There's nothing. I could probably start shorting bonds, maybe. but I feel like I'm chasing it to some extent, right? Because obviously the rates are rocketing higher, and I still do believe the rates will continue to go higher until it catches up to the rate of inflation, because that's what the free market in bonds will do. Because naturally the bondholders want positive real rates from investing in bonds, and so it will have to eventually catch up to the rate of inflation or go higher than that. So I think bonds can probably fall, which means shorting bonds could be profitable during this time. But I feel like, I mean, if I wanted to do that, I should, in hindsight, I should have done that a long time ago, right? But I feel like I'm chasing. So yeah, literally, I probably don't have anything to go into, because I feel like I'm positioned in the right sectors, mostly uranium. I mean, uranium, we've got heaps of triggers coming in Q4, right? So to name one, it's Kapat, right? So ANU is raising 500 million in Q4 and Q4 this year and Q1 next year. And I believe that's going to be like, spot 2.0, right? So we've got that trigger. I mean, gold and silver, for me right now, they are so ridiculously undervalued. The charts look horrible, right? If I just take you to gold chart, for example, it's lost its support at the 200 weekly moving average, and the chart looks absolutely horrible. But am I going to do anything about it? So we've just lost it, just like we did in 2013.
I don't think you're sharing your screen, Scott.
Oh, sorry. So we've lost. This is a 200 weekly moving average. We've lost it just like we did back in 2013, right? So we've lost the 200 weekly moving average, and that was the bear market for gold. We've just lost the 200 weekly moving average. But is this the time to sell? I don't think so, because what do we have behind us? We've got massive inflation, massive money printing, and people rotating money out of bonds. So what does that really resemble then? What is it comparable to? I think it might be comparable to somewhere around here, where it did break below 200 weekly moving average. And once we rocketed, that was the slingshot pattern, right? Slingshot cheetah pattern, where it did a false breakdown below 200 weekly moving average. So would I buy right now? Maybe. But maybe the safer entry point is to wait until it pops back up and shows us that it was a false breakdown. But regardless, I think there is nothing that I would prefer to be in right now, given the market conditions. How about you, Andy?
Well, I mean, my problem is that I have to be in this stuff. I think that the fundamentals are too strong for me not to be in it. And I think that the problem, at least in my opinion, the problem is energy driven. So why would I get out of something where the solution doesn't exist yet? It just doesn't make sense to me. And I mean, that's what I think. And I think we've done the first wave, and that we're going to have a cyclical pullback. I don't know how big this is going to be. I don't know if anyone knows that. We can throw all the Fibonacci and sequences and math at it, and I still won't believe it, because I know once I get bullish on something, I want to hold that thing. And even though if it were to come back down, I'd just buy more of it. I don't want to lose that position because of me being scared, even though all the fundamentals say it's good to go. So the time frame, I think, is the problem that people have, and the volatility is what hurts a lot of new investors. So when I look at those, like a new investor, hold on. Yeah, I think what new investors expect is that they expect a bull market, and they think that everything's just going to go straight up. There's going to be no pullbacks. There's going to be no problems. And that's just not how the game is played. The game isn't played where you start playing and you just go straight to the championship game and you just win everything. It just doesn't work like that. I guess maybe some people, they have played that game, but usually if you're playing the high stakes, if you're at the high stakes table, you're going to have some volatility. You're going to have some losses. You're going to have some strategies. You're going to have to figure out how to navigate through it. And I think the expectations that a lot of new investors have is that this is just going to be super easy, that you could buy a stock and it could go down 40% from your purchase price, even though the stock is down 80% off its high. It happens, and it's actually happens quite regularly. So we call it kind of the grind period, where we grind on the bottom for a while before the money starts coming in and flowing in, and it just takes time. And if you're going for the big moves and you're trying to buy bottoms, this is what it feels like. It feels, like boring, and it feels like it's not working. And I know a lot of people, oh, there's the time value of money, and we should always be invested in things that are going up. The problem is you're taking infinite amount of risk. Like, how many people actually make money doing that? No one does. So you're like chasing a fairy tale. Basically what you're saying is you're looking for evidence of Santa. And if Santa doesn't exist, you have no evidence of Santa. So what we're seeing is I don't know of anybody who's made a lot of money short-term trading. I just don't know of any. All these guys that are super popular, you know what they actually did? You know what Peter Lynch, I think, is the guy that you were talking about. Peter Lynch and Warren Buffett. What they did to become successful is they lengthened their time frames to massive levels. Buffett says, buy a stock and never sell it. That is his time frame. And you guys are looking like at these month-to-month movements of these areas that they go up and down. And Buffett's like, no, I buy something, even if it, if it's of good value, I buy it, irrespective of what the charts necessarily look like. And then I hold it for like 30, 40 years. Now, I'm not saying that you want to do that with cyclical stocks like commodities, but what I think you kind of have to think about is your time frames. And the time frames have to be long enough for it to work, short enough where you're close enough to the launch. And I think the majority of these are short, they're short enough for a launch here at some point. But I also think that we're going to go through some pretty crappy times. I mean, it's going to be volatile. You're going to move all around. And depending on when you purchased, it may feel kind of bad because you're down in your positions. I'm down in positions that I've purchased in certain companies. I'm way up in other positions. And that's just part of the game. It's part of the game. And I know it's not a fun part of the game, but if you have a destination that you want to get to, you're going to have to ride through this long plane ride to get to that destination. It's not going to be a short little plane ride. And sometimes it is. Sometimes you get lucky. Sometimes you time something very well, and that's what we try to do. And sometimes you have to ride through some volatility because the overall markets need to puke whatever, they need to puke to the downside before you move on up. But you can be bearish on different time frames and bullish on the same stock. I'm bullish long term, and I can be bearish on something in the short term on the same sector, same stock. So what I'm doing is I'm trying to eliminate any sort of low statistical probabilities of outcomes. So the way that I remove the low statistical ability of outcomes is remove the short-term noise. So if you were to look at a big long-term picture and you just looked at everything, what do we have? We've got a breakout of rates to the upside on the 10-year, the 30-year, and all these different time frames. If you look at the stocks and the commodity to stock ratios, we can see that they're breaking out of these long-term bases as well to the upside from very low levels. So where you look from a long-term perspective, it's breaking from low levels upward in a positive fashion for us. Now, is there a possibility that we have to ride through a recession? Yes, that is a possibility. And the symmetry in the move is so large on the opposite side of that bet that it's worth the wait. It's kind of like your timing is not right if you meet a girl or a boy. Like the timing isn't there. You're going into the military and they are going to college. You guys separate, and that is your recession, so to speak. And then you come back, you're all excited, it's awesome, and the timing's right, and it just happens to work. I'm just giving an example here. But I mean, that's just like investing. It's the same thing, And I think the expectations of this easy ride that just goes straight higher it's not the right expectation. So we talked about all that. in terms of the time frames and all that. What's your opinions on that, Scott? What do you want to share?
I want to share something because I think I'm noticing something really interesting as well. And so if I look at the bigger oil names right now, so this is ExxonMobil Corporation, and you see a pretty good strength, like pretty good buying despite the drawdown in oil price, right? So it hasn't gone down that much, XOM. And so what this is telling me is that the smart money is utilizing this opportunity of lower oil prices, you know, causing a bit of panic in the among the retail investors, and they're buying this thing up. And if I look at the biggest oil producer in Australia as well, Woodside Energy Group, you're seeing the same thing. This is like huge strength despite the drawdown in oil price. I think this is pretty similar to if you look at the 2000s, for example. I think we saw that. So
well, you can look back on that chart in the 2000s. Yeah, it came back.
Yeah, 2000. So we had a drawdown here up until this point, and you saw pretty good strength in the oil producers back then as well, despite the 50% drawdown in oil price. And I think you see the same if you just go back to the ExxonMobil Corporation as well. So up until here, I mean, you did have a bit of sell-off here, I think with the broader markets perhaps, but then oil price drew down, but then the ExxonMobil share price didn't come down that much. And I think we're seeing something similar here, which is oil price has gone down quite a bit if you measure it. And usually what happens with share prices, you know that they are more volatile, more leveraged to the oil price, which means they should be moving further than the oil price themselves. But okay, so we had 39% drawdown in oil price, which means I think we're getting close. So if we were to draw down 50% from the highs, it means, and Andy and I have talked about the potential downside for oil from months ago, right? Where the key support is, and we always thought it was between 65 and 75. Who knows? It could pierce slightly below, but that's all good. But if I just do a measured move for ExxonMobil, it's only gone down 18% compared to 39% in oil price, which tells me once again the institutional money, the smart money, is trying to utilize this opportunity in the market drawdown, general equities drawdown, and also the spot price falling into positioning themselves into these oil stocks. And that's really interesting because what is coming for oil, Andy? We've got strategic petroleum reserve the release that's gonna stop towards the end of October. So we could be nearly there. Like, this is why you don't try and time it, because you see signs like this where smart money is positioning themselves. And I think if you also look at something like Occidental Petroleum Reserve, look at that's a massive strength in face of oil prices drawing down like this. So from the high to the low here, that's 23% drawdown. That's a massive relative strength against the oil price, which once again, like despite the broad market sell-off and despite the drawdown in oil price, the spot price of oil, like smart money is utilizing this opportunity to position themselves. That's what I think. And I think we all know, realistically, let's just completely ignore the price movements, right? Completely ignore it. We all know energy crisis here, and the energy crisis here right now. Right, we don't even need to look any further than to say, look at the Strategic Petroleum Reserve drawing down like half of their reserve or something since they started the release, and they're continuing to release it. And you know, that in itself is a very sure evidence that our production is nowhere near enough to support the current consumption. It's the demand destruction by I won't say it, but demand destruction isn't there. Like I think the only way that you're going to be destroying demand is if you just don't have enough supply. Like if you just run out of oil, that will cause demand destruction because there can be no demand if there's no supply. But I mean, right now, demand is way exceeding supply of oil, right? And we can simply see that through SPR release. And so for me, like if you just focus on what matters, and it's not the daily movement, guys. Like, I mean, daily movements is just something that we should all be ignoring. And it's really the big picture that we need to be focusing on. Look for the right signs, like relative strength in these big oil companies, which means smart money is going in while all the retail investors are panicking. That's what the charts are telling us. And if you look at CCJ, I know it's got a pretty big one down day or a couple of down days. But if you look at CCJ relative to SPX, Let me share my screen again.
Oh.
This is massive strength. Like for me, this is massive strength. Look at the fat green candle here. And like that's a little bloody nose, as you call it, Andy. So,
Yep. The bloody
I mean,
nose.
the smart money is getting into energy. And it doesn't be, and as I continue to say, it's always in the bigger miners and bigger producers where you'll see the strength first, because it's the smart money positioning themselves before they pile into the spot prices and before they pile into maybe the mid caps. They will be looking for the most liquid names. They will just position themselves in it, and it's very easy for a sector like uranium for them to just throw in a little bit of money into spot or something like that and move spot prices massively. So they will be positioning themselves in the bigger names like ExxonMobil, the bigger institutions, ExxonMobil, Oxy, Woodside, and Chemical in case of uranium. So I think these relative strength is telling. It's very telling, and I don't think I think you want to be focused on the right signs of this bull market, and you want to be completely ignoring any of the noise out there. And we did mention this a couple of times that CCJ, a name like CCJ. So if you look at the Livermore's bullish cylinder, I think this is pretty important as well. And the number doesn't have to be exact. But what I tended to find in my research was that if you look at this Livermore's bullish cylinder, what I tended to find is with the bigger names, they outperformed. So we are within accumulation cylinder. I'll just show you that, right? CCJ. So if we just go back to the CCJ chart, just put that on a weekly time frame. This is the Livermore cylinder, right? So we are within this Livermore's bullish cylinder. I'll just zoom in, turn this off. Right, so we are in this accumulation cylinder somewhere here. I don't know the exact number. We're probably like somewhere around here is my guess. But until around this point, if I look at the last uranium bull market and compare CCJ, Chemical Corporation's performance against all the smaller miners, including the mid caps and all the explorers, CCJ's performance relative to the other smaller names was better up until around this point, until we went into the mid cheater mode. Like even once we break out of CCJ, we could still see our performance in CCJ and other producers like Paladin Energy, and bigger names like Boss Energy in Australia, for example. We could see relative strength, and then it's the mid caps and the explorers that catches up and does an explosive move. And so if you're in developers and explorers just waiting for this to play out, yes, of course, it's going to be a little bit tiring, but I think you just need to know. And that's why I haven't fully gone into developers and explorers yet. And I don't know if I will ever do that. But, you know, one of my biggest positions is right now in the producers. And this is why, because I know that until the sector catches on fire, it breaks out of that Livermore's bullish cylinder, you know, I know that the institutional money will be positioning themselves first before the retail investors pile in. And so that's something probably that people need to be aware of. And it's going to be the same across all commodities. It's going to be the same in oil. As you've seen, ExxonMobil, Woodside, Oxy, they're all positioning themselves right now. You can see that through the charts in relative strength, right? Can you maybe give me, Andy, some smaller oil names?
For like just to look at a chart or something?
Just,
I mean,
just
SM
looking
Energy
at
is really
chart.
small if you want to look at that one.
Okay, so I mean the drawdown isn't too bad at all, actually, even for SM Energy, if you compare it to the oil price, which means once again, like maybe the investors are smarter than just knowing, just looking at the spot price of oil and determining what they're going to do with their investment. Because what is this? That's not bad at all. Like, I mean, it's still outperformed the price of spot price of oil, actually.
Mm-hmm.
So oil went down 39%, SM Energy only went down 35%. So that's relative strength once again, which is very abnormal to see, right? Because you would expect bigger drawdowns in the leveraged producers of oil, but you're not seeing that, which means I think this is telling. I think this is telling. I think this means that the investors know what's gonna happen short to medium term, perhaps.
Yeah, I also think that they could even break out of those accumulation cylinders and still go up quite a bit. I think that happened last bull market in the early 2000s for Camco even. And what I'm trying to think of is how do you convey information to a new investor? Like, what do they exactly need to become successful? To jump the gap from being new to seasoned almost. Because what people do is they look at their account, they see it go down, and they're like, this is a crap investment. It's like, well, I mean, if you're in commodities, it's going to be volatile. Like, you're going to go up, it's going to go down, and you're going to get these drawdowns. And I don't think there's any way to avoid not feeling those emotions. Like, you're going to get the drawdowns no matter what. If you're trying to do a long-term investment. If you're trying to time this stuff, I mean, you can get absolutely slaughtered in the short term, because what you're going to be doing is you're probably going to revert back to your emotions and then sell at the wrong time and buy at the wrong time. So I don't know how a young investor can navigate this quickly, because you're going to have to get all of the knowledge up front. And the easiest way to do it is to buy it and just hold on for the entire ride and just ride through this volatility. And some of these, they're late stage performers. Like, I know shipping's a little bit behind everything else. You might be sitting in it for a while. I mean, it doesn't mean that this is just going to necessarily just blow the doors off everything. But if it's in your strategy and you have a portfolio allocation to it and you position size it correctly, somewhere that's going down or sideways, another spot should hopefully be pulling that portfolio up, kind of diversify you out a little bit. And I know people are going to try to time this. They're going to try to time this sector and then swap into this sector and then swap into that sector. Maybe you'll be successful. Maybe you won't. I think they tend to move kind of similarly together, and money's just going to kind of indiscriminately turn and buy a bunch of different commodity stocks. So that's kind of my viewpoint. But, I'm not playing that type of movement myself. I'm just kind of looking at it going, these are the insanely good companies. And then I'm going to load up like heck in those good companies and just ride it. So I know people are going to say, I told you so. There's this recession, or there's this pullback, or there's XYZ. And it's like, how much are you up from 2020? I mean, in all honesty, why should I be taking advice from someone else when you get a good position and then you just ride this thing up? Do they actually know the short-term path? They don't. I don't care who it is. You could bring on, famous investors. They don't know. They don't know the future. No one here. I don't know the future. Scott doesn't. Nobody knows the future. So why would I, if the symmetry in the investment is so large and it still has good value, why would I be messing around with short-term movements? And I know that people, they always talk about all these, a 50% down moves 100% upside and all this other stuff. It's like, well, what if you have 100% upside? Who cares about a 50% pullback? You buy more. Because if your upsides are so large, they're 20x, 30x, 40x, 50x, or whatever, and in order for that to get that type of symmetry, your volatility is going to be massive. In order to buy the stock within 6% of the bottom is probably impossible. I mean, within 6%, that's like a daily move. So what happens is new investors think they got to put stop losses. They got to do all this stuff. You buy a stock at $1.50, we'll call it SM Energy, in September of 2020. Did you know I did not buy that stock within 6% of the bottom? The stock went down, I think, to $1.30 something for a short period of time, like $1.35. So if I bought that stock, which is now, I don't even know what it is because it went down some, 20 or 30 times my money or whatever, 26.
36.
Or it's 36x?
Yeah, 36 right now.
Oh, wow, nice.
Okay, 20 something x right now, but it did
20
go up to
something
like
x right
40x
now.
one stage.
But if it went down to $1.35 and I bought it at $1.50 minus $1.35, of course you guys can't see it, but That's 15 cents I was off, divided by 1.5. I was down 10%. So if I had a 6% stop loss, oh, we got to keep those stop losses tight, because I'm a really good trader, blah, 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 blah. Guys, it's really annoying. I had a loss of 10% in that position when I first put it on. And I bought pretty close to the bottom. I didn't think I could do much better than what I did. And I did buy more as it went down, and I had some volatility. And that's how I got my $1.50 cost basis. So I did buy multiple times, and some of it was at $1.43, stuff like that. But I don't think it's possible to do what some of these guys think they can do, which is keep a tight stop loss. I mean, you could put a stop loss underneath, you can do all that stuff. I just don't see the success. And all these traders are like, oh, I got a 45% gain here, or 100% gain. I'm gonna pull up Excel real quick just to kind of I'm just gonna see for my own thing here. And I don't have it up there. I'm just gonna kind of do it real quick because I don't know what my actual return is times. I don't even know 300% on that in two years. No, it's more than that. My compounding return, what is it? It'd be 36 divided by 2 is like 6. It's 600% or something, or 500%, somewhere in that range. It's 500 to 600% compounding return for 2 years. If I take 2 years, if you were getting a 40% return and you took $1,000, you had a 40% return, you have a $400 profit. And in order for you to have a 40% return, you'd have to have, what is that? I'd turn 1,000 into $26,000. You'd take 26,000 divided by 400. You'd have to have 65 trades at 40% returns in order to match my one position in 2 years. How many people do you know get 40% return 65 times and be successful 65 times? You might have, some losses that you have to make up. So what, you have to have 100 successful trades, and maybe you have 20 losses, and you have to get an average of 40% on each of those trades in 2 years to match that. I think that's almost impossible. So it's all you need is a couple of these things. And I had some other ones that did very well that are well over 10 times the money as well. My overall return in the portfolio for the 2-year time frame is 550%. That's 6.5 times my entire portfolio in 2 years. And it's gone down a little bit below. Maybe it's like 6 times or 5.5 times now that we had the strong pullback this week. But that's what it was when I last saw it. But it is so hard to do that trading. I don't know how I don't think it's possible. There's no way. I don't know of anybody. I mean, maybe there is, but I think it'd just be very difficult. And if they did, I'd like to see their returns and can screenshot it and compare screenshots or something. I just want to see it, know what the heck they're doing. But as a new investor, you're going to get creamed in the short-term game. I think. I just think you don't know insider information. You don't have algorithms. I don't know. I just think you're going to get creamed. I think you'll lose money, not gain money. So then you have to ask yourself as an investor, if you're new, how do you navigate the market? What are you going to do? The loss is inevitable. It's going to happen. You will have volatility. You will have losses in your account. That is unavoidable. The question is, how are you going to handle those losses, and what are you going to do about it? And the way that you make a lot of money is exactly what your body's telling you not to do. You get panicked and it's emotional and you see fear, you're going to have to do something that your body doesn't want to necessarily do, which is buy.
Okay, I will ask you this, Andy, because back in the 2000s, for me, I don't know if it's just personal traits or not, but I've never felt panicky investing. Like
Mhm.
even if I look back at myself in 2000s, I don't think I've ever panicked like the way some people are panicking right now. Do you think it might have something to do? I mean, obviously, personal trade is obvious thing, right?
Mhm.
But do you think it might also have something to do with the information that's so readily available right now? Because obviously, I'm just thinking back, right? I'm just thinking back to the 2000s, and I think the biggest gain in my account that I saw was actually when I was on holiday, and I couldn't check my account for like 4 weeks because the only way to check your account was to be in front of a computer back then, right? Because you didn't have
Mhm.
any of that information on your phone or anything like that. So like you could not check it continuously like people are doing right now, right? So max I could check it was like once or twice per day, and I never panicked. Do you think it might have something to do with that? Like, do you think the best advice? What I'm trying to say is, do you think the best advice that we can give to the new investors right now is to say, guys, just switch off, don't check your accounts. Like maybe just totally switch off from it. If you've studied the markets hard enough, if you study the fundamentals or the thesis hard enough, and you're confident, you've got the conviction now that the commodities is the next thing that's going to take off, is the best advice that you just switch off and not like be stuck on your screens looking at the price movements. Do you think that could be it?
Well, I mean, I think it deals with personality types and things internal to the person. And I know everybody's different, so they're going to feel emotion and swings differently than maybe yourself or myself. Um, I still feel, like I don't like logging in my account and seeing a very big down day. Obviously, I don't like that. I don't feel like, I look at it, I'm like, oh man, that's a lot of money. Like son of a, it's it's not easy to swallow. And sometimes it's kind of like losing your breath. If you're down 8%, you have a lot of money in there. But um, for a new investor, even if you get all the knowledge, I still don't think you can bypass that emotional feeling, for some people at least. So I don't, it's difficult to say how you'd have to really take that because it's going to be based off of each individual, and I don't know how they're going to take that. So some people, I think they shouldn't be in the commodity markets at all because it's so
Yeah,
volatile.
I
I don't
agree.
know if they can handle it.
Agree.
Um,
Yes.
but others, I think, if you want to try to shorten your time frame to retirement or shorten your time frame for that car that you want to buy or whatever the heck it is, I don't know what it is. I think you just have to learn how to deal with the volatility. And I've never been a short-term person. Like I'd go pick up candy from, like Halloween. I would save it all and never spend it. I would never eat it, which is probably a good thing because it's all sugar and, a bunch of garbage, but I'd go collect all of it. I had fun collecting it and then I would never eat it. I'd eat like 3 pieces and I'm like, okay, that's okay. But so I've always been that way. So the way that I view these investments is I collect all these things almost like baseball cards or something. Like you collect these portfolio and you just let it sit there and it goes up and down. And I think you kind of have to have an attitude where you don't care about some of it too. This can't be money that you need, I would say, but this stuff isn't what I have to have in order to survive. So I kind of get that attitude where it's like, you know, you only live once. Screw it, I'm going to go for it. And with some of my money, and I swing for the fence. Why not? Other people, they think they can swing for the fence, and they feel that first hit, and they say, "Well, whoa, 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 this is way too much." It's like, yeah, that's part of investing. That is what you need to feel. That's what you need to experience to get to the state that you want to be in. You have to have losses. You have to have volatility. You have to know how to handle it. You have to go to a completely other emotional state of mind to get to the spot that you want to get to. You can't be at level one or stage one where something doesn't go your way and you just drop to the ground and cry like a 3-year-old because they haven't developed yet. 3-year-olds, they cry about everything. They can't control their emotions. They kick, they punch. They don't. If they don't get what they want, that's how they act. You see adults that also act that way. They just never really grew up, I guess. But that could be a personality trait. It could be a form of immaturity. It could be a form of, not being able to handle stress or something like that. There's a lot of things that, I went through a difficult time, going through engineering school and going through math and science, and you kind of look at everything else. You're like, this stuff is easy. Like, it's not hard. Like, you go through the really difficult stuff, and then you have to really grow up. I mean, that's really what it is. And you start making all these difficult decisions. And that's when I think people, I don't know, they grow up. And I think there's a form of maturity that you have to have in order to kind of ride through some of this stuff. You have to have a certain level of understanding. But, I've got a background where I've like, you dig into the numbers, you dig into data. And if you don't have that data and you haven't dug into the numbers, and you don't know kind of what you're doing, it's almost impossible to hold on to this then. And
Yep.
what happens is, I think people, when they're newer, they just kind of latch on to people's opinions, looking on YouTube. They latch on, they listen to it, and then they try to make a decision based off of what they consider experts to be and what they tell them. But they don't know that the path that they're taking is going to be, a whole bunch of forks in the road that may work and may not work, may be difficult, may be bumpy. You're going to go up and down, all around, spins you. They basically put the bat on your head, you spin around, and then to go tell you to run. And that's like commodity investing to some degree, because you're disoriented sometimes with the prices. You could be ultra bullish. The sector, they've got deficits. Everything should be going higher. And when the markets don't go higher, they don't know what to do. They say, why is this not going higher? Why is it going down when everything is bullish? And you know what? Markets do that. And I don't have like the greatest answer in the world for you. And it's like, once the inventories go crazy to some crazy level to the downside and the deficits remain, then all of a sudden it's like people just wake up. It's like, think about it this way. You've got a job. I've got a job. We have jobs, right? We're probably more passionate about the money that you have in your portfolio, right? So you're going to look at that after, you're going to look after that money. You're going to do more research on it and be passionate about the money, because you want that to be successful, because it's your money. It's your, whatever it is, however you want to call it. All these people just work at jobs at these big corporations, and they don't really necessarily they're not that fully invested into it. So they kind of just do whatever, and they're going to go the same path until some other event where they start losing money forces them to do something. Those are the people you're dealing with. You're not dealing with people who are, handling their own money. They're just doing it because it's a job. And I think that's what, is difficult, is if you could be more well informed in this than all of those people are that have those regular jobs, because they don't care about it. They just want to go to work, get a paycheck, and leave. So that's kind of my take on it, is we're probably more fully vested and probably know more than what maybe some other people know about this, because we've done the research. And people just get, I think, discouraged that it doesn't work in the time frame that they put in their mind that it was going to work. And the volatility then kind of puts them over the edge if the time frame isn't perfect for them. This should happen in 6 months. Well, who says it should happen in 6 months? It's a fictitious timeline that you created. It's an expectation that you created. The market doesn't care what you create in your mind. You are the slave. That is the master, so to speak. You're going to do whatever the market's going to do. If it wants to go down, you go down. If it's going to go up, you go up. All you can control is your purchase price and when you bought it. Like the timing of it and the purchase price. And if it's of good value, who's to say that you shouldn't buy it if it's a huge asymmetric bet? I just buy it, goes down more, we buy some more, try the technical analysis, try to time it as best you can. That's all you literally can do. You can't force a move. You have no control over that. So if you're a new investor and you're trying to control things, like if you're running a business, you have massive control over a business. That's what you should do then. If you have more control, put more money in the things that you can control. In investments, as you gain more investment income, or if you get more income, then you put it in investments, you kind of have to just ride the wave. And you have to have a personality where you ride the wave. It's not, oh, this money has to go higher. And I think what people think is that you put it in investment, and the investment just goes up. It's like, it doesn't work that way. If you want the big money, you have to ride through the volatility. It's just the way it is. 60%, 70% pullbacks are possible in bull markets, not even in bear markets. You don't even want to know what bear markets feel like. from top to bottom. So what else do you have, Scott? I know I said a lot there.
No, I think what you said there, right, right before is really important around personality traits. So I was reading a book, I think last year, where basically like they were comparing basketball players and things like that to traders and investors. And not everyone's actually made for investing, and not everyone's made for trading. Like there are some people that are just better off, putting their money in deposit accounts or something like that, earning minimal interest, because that's what, at the end of the day, they will feel most comfortable with. Not everyone can play basketball. I can't play basketball well. Not everyone can be Tiger Woods. Like not everyone can be a golfer. Not everyone can be like a scientist, right? So everyone's built differently. And I think it's so important to recognize that if you're really deteriorating in your health or life or anything like that because of your investment in commodities, you should seriously consider getting out. I mean, I think that's important. For me personally, like it doesn't affect me at all. Like these drawdowns, like if I'm 100% honest, maybe I'll feel it like 1 or 2 days a year. Like that's to the extent that it will affect me, because for me, like it just doesn't matter. Like and the only times I'll feel it is when I kind of walk away from God a little bit, because I'm a Christian. When I walk away from God a little bit and I haven't read the Bible, I haven't listened to his words, that's probably when I will feel it. But like I mean, for me, it just, yeah, I don't feel the pain from watching red days. And I actually sleep a lot better during red days. I'm like, I can go to bed today. I sleep like a baby. And on green days, I can't sleep because I get excited. I mean, I don't know. Maybe I'm blessed in that sense, because I do get super excited when I see like really fat green days, and like I tend to just go mad and care like on red days. So maybe it's like a personal trait I have, and like maybe it's just a blessing. But I'm recognizing and identifying the fact that it's not the same for everyone. And I think it's really important to just look at yourself and really just reassess who you are as a person. Like, are you born to be an investor or a trader, or are you not? Like, are you, because some people might never grow out of it, right? So we talked about the maturity, but like some people might, there are some people that never change. There are certain aspects of, like my dad, for example, like who's hitting 70 this year, that's never gonna change about him, regardless of his age. So I think it's really important to just reflect on yourself and think about whether you want to be an investor, or whether you would be better off just investing, putting your money in deposit accounts. It's really important, I think.
I agree. I'm a very patient person, so, and I don't really spend a lot of money either. So I kind of just, it's like whatever, just let it ride. That's how I look at things. I just let it ride.
Yeah.
And I couldn't imagine selling my oil positions right now. There's no way.
Yeah.
There's no way.
No way.
I'm looking to buy more,
No way.
like massively more. So I don't know. That's my viewpoint there, and I don't know. I don't know. It's hard to explain to somebody
Hard to say.
that state of mind, I should say, because I know a lot of people want to know that. It's like, how do you stick through this? It's like, I see the deficit. I focus on what's in front of me. I look out, and all I see are short-term movements where I can buy more. It's like, if it comes back down, I'll buy more. And other people, they see the loss, and they can't get over the loss. That's what they see. They see only what the emotions telling them in the initial reaction. I don't see that. I see it as just an annoyance. We'll get through this. This is just annoying. Let's get this thing through. And I've seen my account go up and down massively, like many times. So we're talking 50% drawdowns in your entire account value of an account I have, and that could be a very large account value. It might be 5 or 6 or 7 or 8 times my salary, and then you're going to have to kind of ride through it. So I mean, that's the way that I view it. And it's like, when you have a small account value, it's not a big deal. Oh, you're down $600. I'm like, okay, you're in a different level, like psychologically, being down $600 versus being down 600,000 or being down 6 million. It's a different league, I think. And I think when you start making a lot more money, it gets harder, not easier. because the values get so large and the margin of error becomes greater and greater, so to speak. So, you know, a 15% up day on a ton of money is a lot of money, like the absolute value. So that's, I mean, that's what I think. I don't think it gets easier. I think it gets a lot harder because the stakes become that much larger. And it feels like you have to do more or become better. But so that's all I've got. What got anything else, Scott?
No.
Yeah.
The Bible says, "Do not worry about tomorrow, for tomorrow will take care of itself." I think realistically, I mean, another way that I look at it, I know realistically, nothing that happens to my account will change my life short term to the medium term. Like, who cares if the numbers moving in my account? Like, realistically, am I going to starve? No. It's not going to change where I live, what car I drive, what food I get, whether I drink water or not. It doesn't change a thing, right? So I think it's really just important to remember that, you know, you're being taken care of already. Just do not worry. Worry is just, I mean, my wife actually shared with me this week the 5 biggest regrets before people die or something like that.
Mhm.
And like one was worrying too much. Because a lot of the things that you worry about never eventuate anyway. Like, if you really think about it, a lot of things that you worry, I mean, think about the things that you were worried about on a daily basis. Like, did they eventuate? Answer is probably no, like 99% of the time. So don't worry. And another thing was, don't work too hard that you don't spend time with your family. And I think investing counts towards that, because if you're continuously checking on your phone, checking your account, like, I don't really check daily movements. I might log in here and there and then have a look, but I don't spend a lot of time each day looking at the price movements, right? So I think it equally applies to anyone who's looking at the accounts continuously, because that draws time away from your family, your precious time that you could be spending today and right now. And I think that's just so important. Like, just toss it away. The market will do, as Andy said, market will do what it wants to do, regardless of what you want it to do. So
Mhm.
there's no point in looking at it. Like, no point in getting fixated on the price movement. So yeah, don't worry. Hopefully.
All right. Well, that's all I've got, Scott. Thanks for coming on. I really appreciate it. If
Thanks
you
for
guys
having me.
want, definitely check out his channel, Sow and Reap Capital. You can also find me on his channel every once in a while too. So look for me over there as well. And thanks for coming on, Scott. Really appreciate it.
Thank you.
All right. See you guys.
See ya.